Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
Oh, I'm very good, Bryce. Very excited for this interview. Always excited, but I say but because I reckon a lot of people listening may not be excited.
Okay.
Because the theme of today's episode is Australian large cap stocks.
Ooh, banks and miners, baby.
Banks and miners, baby. And unfortunately, Aussie largers have a bad reputation. They are seen as boring. The top of the market is maybe seen as too consolidated, which is ironic given how consolidated the US is, but that's another story. But our guest today is here to change that mindset. He's here to challenge the idea that there's not opportunity in Aussie largers, and he's going to tell us why we shouldn't sleep on those big stocks.
That's it. We are going to be joined by David Wilson from First Sentier. He's the Deputy Head of the Australian Equities Growth. And we're talking today about the First Sentier Geared Australian Share Complex ETF that they've launched. The ticker is LEVR. So I'm a bit excited, Ren, because there's an undercurrent of leverage in today's episode.
Yes. So for people who are unfamiliar with Bryce's core portfolio, it has some levered ETFs.
Yeah.
And I imagine the prospect of more leveraged ETFs coming to market has you absolutely salivating. So we will try and restrain you when we're joined by David. But look, I think it's going to be an interesting one because we asked him to bring a couple of stocks to go deep on. And towards the end of the episode, we're going to go through three very different Aussie companies. We're going to talk about Brambles, a company that I think has the best moat in the game.
Yep.
We're going to talk about ResMed, and we're going to talk about NAB. So it'll be interesting to see what David sees sort of unites all three of those companies, what characteristics he draws out that gets him excited about some of these Aussie large stocks. We're going to talk about how you manage a portfolio with leverage. So a lot to cover.
So before we jump into it, a reminder that if you're not currently subscribed to the Equity Mates newsletter, you should definitely do so because we keep you up to date with what's going on across the globe. We summarize the major business headlines in dot point form and send it to you 6 a.m. every morning so you don't have to spend your time trawling through the daily news. So there'll be a link in the show notes to sign up.
Now, before we get into it, we want to say a massive thank you to First Sentier for sponsoring this episode and helping us keep all of our content free here at Equity Mates. You can find out more about their range of products and their new active ETF via the link in the show notes. But Bryce, with that said, let's get to our conversation with David Wilson.
David, welcome to Equity Mates.
Good to be here, Bryce.
Just banks and miners, that's often what the ASX is commonly referred to as. But let's start by challenging the idea that Aussie large caps are too concentrated and slow growing. Tell us why they aren't.
I think what Australia has emerged as over the last probably 15, 20 years is we've actually shown ourselves to be pretty good at generating new companies, new global companies that are actually global leaders. So you look at Goodman, Computershare, Brambles, Aristocrat, Cochlear, and now even with the new tech names, companies like WiseTech, Technology One, Xero. These are great Australian success stories. So we in Australia like to beat up ourselves too much, but when you look at that array of companies, it's just a great opportunity for investors such as ourselves.
I feel you're going to make me really proud of Australia by the end of this interview, David. But we should acknowledge for our friends over in New Zealand that whilst we like to claim a lot of their things, Lamingtons and the like, Xero actually is a New Zealand company.
I take the view with New Zealand things that if they're good, they're Australian.
Ours. Yeah, nice.
Right. But so therefore, like with someone like, if Russell Crowe's behaviour is good, then he's Australian. If it's not so good, he's a Kiwi.
Nice. All right, we'll run with that.
I have no problems with that.
But like what you say, I think when you say it, it's kind of self-evident. It's true. Like we've got some cracking companies in Australia that are not just in Australia anymore, but the reputation of just banks and miners is, I guess, a hard one to shake. What do you think the ingredients or the elements are that in Australia and in the Aussie market that make it competitive and able to produce some great successes?
The first thing I'd say, just back on our banks and miners, is that actually our banks on global comparisons are actually pretty good.
Fair. And our miners also world-class?
Well, we have the two most profitable mining companies in the world.
Yeah.
And, we often refer to, Australia is the Saudi Arabia of iron ore, right? So... But then I think beyond that, I think because Australian companies have had to operate in a small market with actually high labour costs, they've had to be able to sort of develop productivity gains that they can take and sort of compete with here and then take globally. And so you look at a Brambles, it deals with transportation costs and logistics issues. You look at the same thing with WiseTech, but it does it in the sort of tech space. So I think that sort of small market, and there used to be this sort of view by that fund managers such as ourselves didn't want Australian companies expanding internationally. And we can all talk to the sob stories where Australian companies are blown up overseas, but we can also look at the fact that companies like Brambles, Computershare, Aristocrat would be a lot smaller if they hadn't successfully expanded overseas.
Yeah.
When you're out talking to investors, advisors, even Aussie companies, what are some of the, I guess, frustrations or opinions about the Aussie market that really kind of grind your gears?
I think the first one is that in the tech space, particularly, that only you go to America for tech, and that's right. I'm not going to pretend otherwise that Google, Facebook, Amazon, etc. aren't sort of incredible success stories. But you look at look what Xero's achieved, look what Technology One is now achieving, look at what WiseTech's achieving, and then even go further. You look at sort of Hub and Net Wealth, how they've evolved, and then if you go back further, you look at what REA and car sales have been able to achieve. So, this is sort of idea that, there's only tech in America. Well, there's some fantastic tech stories in Australia.
Yeah.
And New Zealand.
So that's the Australian story. If we zoom in on the strategy that you run and the ASX-listed ETF that you've just launched, you then take the Aussie successes and you add in leverage. And Bryce here, I was telling you before we started recording, Bryce here is a big fan of leverage. So I think he's going to be excited to hear about this.
Yes.
But give us the philosophy behind the fund. Why add leverage to Aussie larges?
It's been a great success story, and the product and the strategy has been a good success story. And really what you do is you've got a sort of a base load of companies like banks and miners and insurers and retailers that have done incredibly well on a very sort of consistent basis, but they also provide a sort of fully franked or highly franked income stream, which allows us to meet the interest requirement that we're required to sort of pay to our lenders. And then once you've got that sort of base load covered, then you're able to, invest in these growth companies, which, as I said, Australia's got an abundance of, and that's how you can put the leverage behind those companies as they expand and grow, and then that way, the leverage can work. Now, of course, leverage works both ways, of course, as we all know, and so therefore, this is a fund that is sort of driven on sort of longer term returns because short term returns can be volatile.
So the fund is the First Sentier Geared Australian Share Complex ETF. The ticker is LEVR. How is the fund actually leveraged?
The way the leverage works is that for every $45 invested by the investor, we are able to, in a position to go and borrow $55 against that. And so then that $100 is then invested in the market. Okay. And we only invest in the ASX 100. And we think that actually gives you an extra sort of quality, a bit more extra liquidity as well in periods of drawdown, and we're able to access appropriately low level of interest as well.
Yeah.
I like how you were saying it makes sense. you get decent borrowing costs because you're institutional, and then you're covering it with the generous dividends that Aussie largers pay. There's some nice synergies there. So it's a relatively new active ETF or complex ETF on the ASX, but it's not a new strategy. So can you give us a little bit of a history lesson and how it's performed against its benchmark?
So the strategy goes back to 1997, as part of the broader Colonial First State group, and so myself, I've been running it since 2017. Predecessors obviously ran it before then. And, the good thing about the strategy is that it's survived the dot-com crash. It survived and flourished through the GFC, through the early stages of COVID. And remember, COVID actually fell in the market fell 30% in record time. It fell 30% in 19 days at the start of COVID. That's the fastest ever. The second fastest was 30% in 20 days back in 1930. And then even just recently on Liberation Day, we had some volatility as well, which I'm certain everyone's aware of. It's a fund that's been able to sort of flourish through those periods. Yes, there's been significant downdrafts. As I said, that's why you do go through these volatile periods, and leverage does work both ways. But over a long period of time, it's been able to materially outperform the broader index.
Now, as Ren said, I love a bit of leverage in my portfolio. Not too much. 50% is probably on the lower side of what I'm comfortable with. Well, what kind of investor is LEVR sort of designed for?
Yeah, that's a great question. And I think the important thing is because the strategy's been around for such a long time, it's a strategy that's well understood. By bringing an ETF to market, then it actually provides a new channel for investors to come into the strategy. What we see over a long period of time is a lot of sort of financial advisors themselves invest in it, plus the sort of younger cohort as well, who have the time to sort of cope with the volatility, and perhaps more affluent investors as well. You don't want to put your last dollar into a geared fund, but they're attracted to the sort of wealth accumulation as well.
Yeah, nice.
So we want to dig down into, I guess, the search for growth in the larger part of the Aussie market, and then we're going to unpack a few companies that you're looking at or that are in the fund, and we'll sort of go deep on them. But just at a higher level and at a general level, what are the characteristics that you're looking for in companies that you think have really strong growth prospects for the next decade?
Really what we're looking for, firstly from a sort of, if you like, just an arithmetic point of view, is that we're looking for just companies and we look at their levels of return on capital and their trend in return on capital. So that's the first thing. Then the second thing is we're looking for a sort of business model where we're almost sort of solving a problem for whether for consumers or providing a service to consumers or providing a service or solving a problem for companies. So we're looking for that, sort of a market presence. And then based on that sort of ability to invest that capital and sort of, have a sort of a winning product, then they're able to sort of grow their earnings and returns over time. The other thing that we do look for as well is that we take a really detailed view when companies do acquisitions, because that gives you some real insight into how they're allocating capital. Yes, we can all talk to the sort of horror stories of various moronic acquisitions, I would say, that have been made over the past 20 years. But by the same token, you look at the acquisitions that CSL made a long time ago, Computershare and Aristocrat, more within the last 5 to 10 years, they've been fantastic acquisitions that have really sort of driven returns for shareholders.
So on acquisitions, because it's always a hard point, because on one hand there's this optimistic story of synergies and new growth opportunities, and then there's a question about, as you said, the history of acquisitions isn't great. And we can look in the rearview mirror and see some that worked and some that didn't. But when a new acquisition is announced, what are you looking for that, is an indication that it might go well, or perhaps there might be a red flag?
Well, the first thing is we look for those red flags.
Yeah.
In fact, and just so you're aware, the collective noun for red flags is a bunting of red flags. Is that right? It's not a herd or a flock. It's a bunting of red flags, because I've had to present that many times. And so we're looking for just, is the company firstly overpaying? Are they using EV to EBITDA because it's a lower number to justify it, because EV/EBITDA is not a smart multiple to be citing. So we're looking at the sort of return metrics. Then we're looking for the logic, or is the acquisition being used to sort of cover up an earnings hole? So we've got to look at it from sort of all angles. And, we think with a sort of financial background, we're in a position where we can do that. If Coles or Woolworths want to put a distribution centre somewhere in Western Sydney, how would I know whether it should be in Campbelltown or Richmond? I just don't have the experience. But I do, if Coles or Woolworths are going to make an acquisition, then I look at the multiples paid, I look at the financial logic, I look at the strategic logic, and then I'm in a far better position to make a call. And that's instructive of their ability and their processes when investing ours, but really our investors' capital.
Ren and I both, I worked at Woolies, Ren worked at Coles, so help us settle the debate here and now. If you had to choose one right now, are you going Woolies or Coles?
That's a very, very sort of tough question. I think of late, Coles have had the momentum.
Yeah.
To use an AFL term, I would actually argue that Coles have been harder at the ball.
Okay.
This is from a rugby league person, but anyway, but I hear that AFL guys. Yeah. But I think Coles have been harder at the ball, but I think Woolworths, it's acknowledged, have a stronger franchise and a stronger sort of sites, particularly in New South Wales. But so I think it's upon Woolworths now to actually demonstrate and sort of reclaim that momentum. But at the moment, again, if we go back to AFL, we're in the third quarter and Coles are in front.
Nice.
All I'm going to say is that Coles is up 35% in the past 12 months and Woolies is up like 6%.
Oh, it's a long-term game.
Very disappointing. Look, we can argue about that all day, but some of the characteristics in the criteria you said there apply for any company, like, whether you're investing with leverage or not. You're looking for companies that can invest capital at high rates of return, that are solving a problem for customers and have good growth prospects. When you add in the leverage overlay, does it change the calculation or does it add any criteria?
It does a little bit. You have to think about it. So our fund is a fund specifically designed with that leverage in mind. It's not a geared version of our other funds. I think that's a really important point. So you've got to be aware that, you've got a sort of Formula One engine behind you, and if you make an error, it's going to get magnified, right? But if you have a success, that is also going to get magnified. So therefore, I think it tends to push you. You don't sort of de-risk, but you sort of look through a sort of quality lens and the company's sort of ability to sort of be able to cope through, whether it's interest rate volatility, economic volatility, microeconomic volatility, whatever that may be. So you just look at the sort of resilience of the business as well.
I imagine companies with higher debt loads become more like something that you want to watch out for. And then also, I guess, like when we start to see like eye-wateringly high valuations, you maybe start to take chips off the table earlier than others?
Yes, so on both of those, yes, we're wary of companies with too much debt. And we also wonder why they've got too much debt. But yes, we sort of makes us a little wary. And generally, though, to be fair, Australian companies are pretty well, not always, but pretty well capitalised. So I don't think it's not such a concern, but you have to be aware of it. And of course, valuation does matter. So we do long-term DCFs to sort of try and capture that value, that sort of valuation. If you're investing in growth companies, you're taking a longer term view. And so therefore you've actually got to do more work to actually sort of support your long-term assumptions. So it actually, our analyst team is actually very good at sort of just, working through the numbers, working through their assumptions to actually support the investment case.
The valuation that has confounded Aussie active managers over the past, call it 24 months, is Commonwealth Bank. So we have to ask, what's your view on they're the most expensive bank in the world? Is that correct?
I think that may be right.
Yeah.
That's a fair sort of comment. And we get questioned that every
sure.
single time we present, we get questioned on Commonwealth Bank valuation. So to be fair to Commonwealth Bank, they haven't done a profit downgrade. They haven't done a dumb acquisition. They manage their succession brilliantly through the Royal Commission, and so you haven't had the sort of CEO reset that you often have with other companies. Their book is actually sort of high quality. Their ROE is sort of 16%. If you change the name from Commonwealth Bank to Commonwealth Industries or Commonwealth Holdings, then you go, okay, still a bit expensive, but, it grows pretty consistently at sort of 3 to 6%. Fully franks its dividend, it's got a good ROE, it manages all its issues effectively, and you compare like a NAB, which is probably the second most profitable bank, like, well, NAB are trying to sort of mirror what CBA are doing in the retail market. So, there's praise in itself. And NAB's ROE, just by comparison, is more like 13.5%. So, and they're improving. So, CBA's got a sort of fantastic franchise. So, yes, you can point to the high multiple, and I think that's right, but there's a lot to support it, just the consistency of what the company's been able to achieve.
God, now we'll see Commonwealth Bank change their name. Commonwealth Industries.
Yeah. When you look across the ASX at the moment, David, are there any sectors that you're specifically seeing a lot of opportunity?
It's we tend to do it sort of a bit more sort of bottom up. It's almost like, sort of comes back to the Commonwealth Bank point. It's almost not so much the sectors, but the quality within a sector. So the better quality businesses within a sector, you look at how REA has performed versus Domain.
Yeah.
You look at how Commonwealth Bank has performed versus ANZ. So, just sort of generally the sort of quality sort of wins out. There's sort of no sector that we sort of really sort of rule out. I think you can point to the fact that the insurance sector has actually done pretty well of late, whereas it was always sort of pushed to the side. But actually, as sort of bank valuations climbed, people then revisited it. IG and Sun have both done a pretty good job at lifting their returns, and QBE have done a fantastic job, in lifting their ROE, because for many years, certain people are aware of the QBE horror stories, and now under sort of really patient guidance and leadership by the current management, the ROE's gone from sort of 6 to 10% to now 15 to 18%, which is, it's pretty good effort.
I said, you'd make me proud about Aussie companies, and the more we talk about these Aussie companies doing good things,
Ren's buying CBA right now.
CBA. No, it's just nice, because so much of our focus is on America these days and the quality that we see over there. But it's a reminder that there's quality closer to home.
I actually like our board structures more than America.
Okay, that's interesting.
So, we have a more sort of British board structure where, generally the chairman and the CEO are not the same person, whereas in the US they tend to be the same person, captain, coach and sole selector. And, I think actually you've got better checks and balances in Australia than you have in the US from that point of view. Plus, you've always got the franking as well.
Yeah.
Hard to beat.
I mean, speaking of better board structures and checks and balances in Australia than America, do you have a view on the James Hardie stuff?
I do have a view on the James Hardie stuff. I think it was a poor transaction. There's no way you can sort of defend it. And I think they overpaid, and it was sort of poorly structured. And so, we weren't. And look, James Hardie has been an actual incredible success story over a long period of time. And, in the same way that Brambles and CSL and Cochlear have as well. But, there's no way you can defend that transaction. It was a poor transaction. They heavily overpaid.
Well, let's go back to the bottom-up search for quality. And we asked you to bring a couple of names that are in the fund or that you're watching that you would be interested in diving deep on. We appreciate that you've brought 3 large Aussie names that are in completely different sectors, NAB, Brambles and ResMed. So which one do you want to start with?
Why don't we start with NAB?
Okay. Most well-known of the 3, one of the big Australian banks. The first question we're going to ask is, what does the company do? But I don't think we need to ask that with NAB.
I hope not.
So what's the investment thesis?
The investment thesis in NAB is that the sort of valuation, obviously everyone points to the CBA valuation, and I'm not saying NAB is higher quality business as CBA yet, but actually it's an improving business. Andrew Irvine, the new CEO, followed on from Ross McEwen, I think brought the right tempo and the right approach at NAB. And so NAB's ROE, as I mentioned before, so really it's RONTA, is 13.5%. And that's improved. I think the other thing is, and this is an important one, is the NAB are actually lifting their share of the mortgages they write through the proprietary channel. That's actually far more profitable for them. And at some degree, they're actually mimicking CBA, whereas sort of Westpac and ANZ, roughly about a third of their mortgages, actually they write through the proprietary channel. CBA is 54%. NAB was down in those 30s and it's now in the early 40s. So, it's far more profitable and it's taken a long period of time. There's no quick fixes in terms of sort of, reaccelerating a bank. So you combine that, put it all together, I think NAB's in a pretty good place. All the banks, there's no arrears issues. Their balance sheets are in pretty good order as well. So I think NAB's an interesting one. It's generally, we have a sort of growth bias, But NAB is sort of, it's part of that bedrock that we're looking for within the portfolio. I think, NAB's a good candidate for that.
Is there anything that you're seeing that you think the market is missing?
NAB, I think it's just that improving proprietary channel. We would emphasise that, and also the way that they've improved the Ronta as well. And I think it was about 4 or 5 years ago where the NAB Ronta went past the Westpac Ronta, and I think that was a great achievement by NAB to be doing that. So I think generally on most metrics, NAB is lifting the quality of their business, and as I said, that's a credit to both Ross McEwen and to Andrew Irvine as well.
And when you say proprietary channel, that means just going direct,
rather than through a mortgage broker.
Do that?
Yeah, that is.
Why would you not use a broker? I'm surprised
because it's more profitable for the bank.
Yeah, but anyway, I find that a fascinating behaviour that, particularly Commonwealth, 54% go direct.
Yeah, but again, it tells you the sort of strength of their relationship. Their great deposit collecting ability as well at CBA. Then CBA and NAB and ANZ and Westpac all advertise. Well, if you're just going to go through brokers, why would you advertise if you're just basically a processing group, which they're not, and sort of NAB's recognised that, and they're lifting that.
Now, you've used the term Ronta a couple of times, not one I've heard before. I'm going to try and guess what it is, and then I'm going to get you to correct me. Is it return on invested net tangible assets?
Return on net tangible assets, return on net. Yeah, that's what it is. It's sort of what it tries to do is remove some of the goodwill that the banks have paid for in the past. And if you pay for a business with your expensive scrip and their expense, and you buy their expensive scrip, then it sort of distorts that number. So we like to bring that way. Once we're back at Ronta, we can compare all the banks more evenly.
Okay. Yeah, nice. Oh, that's a good one. Yeah. Good learning.
Bit of accounting finance.
Yeah. You mentioned there that all the banks aren't seeing too many arrears and that the customer looks in decent order. But when we talk about the Aussie banks in the context of the economy in 2025, I guess that's probably where a lot of people's minds go when it comes to risks or what could break the thesis. Mm-hmm. How do you think about that risk? And then just more generally, what are the risks that you're looking for?
Well, so with the banks, they are levered. So therefore, you need to be mindful, again, where their balance sheets are. But the fact is that it's actually quite hard to get a loan. It's almost like debt's almost like a luxury item. And so the people with the loans can afford those loans as well. You had a lot of APRA sort of measures, over the last sort of 5 to 10 years to sort of shore up the balance sheets as well. But also you think the Australian economy is actually in a pretty good space. Credit growth, which is the bank's sort of revenue line, if you like, is growing at 6 to 7%. Unemployment's 4%. There's no unemployment, so therefore put people in a position where they can pay back their loans. You're not in a position like you were in the early 90s where you had sort of bad commercial real estate situations, where it was really tough. In that, Westpac and ANZ had really tough periods in the early 90s. So from an economic point of view, I don't think the risks are that great. And so the banks, even if you get a slowdown, banks actually are sort of quite soft cyclicals. If you get a sharp downturn like you had in the early 90s, then banks will underperform because they're going to have to issue more shares to sort of, to sort of restore their balance sheet. But that's not the case at the moment. So I think the banks are sort of reasonably sort of, steady, almost dull investments, but that's probably a good thing for a bank.
Well, it's also a good thing for a fund that adds leverage.
Yeah. I'll give you that one.
So the next two companies to pick, we've got ResMed or Brambles.
We'll go to Brambles first. And sort of Brambles, again, had a sort of checkered period for a long period of time. But again, the management that came in there under Graham Chipchase, he sort of, again, patiently sort of improved the business, found out where the lost pallets were going to.
Just before we get too deep into it, I think for people who aren't familiar with Brambles, do you want to just give the one-on-one on what they do?
Yeah, so what Brambles are is that they are a pallet pooling organisation. So you and I, but probably not me, but maybe you, could build a pallet. Yes. I'm pretty hopeless at that sort of stuff. Ask my wife. But nevertheless, so they're the global leaders in pooling pallets. So when a Unilever or a Procter & Gamble or a Coca-Cola need to put their products on a pallet, Brambles are actually the global leader. In the US, across Europe and Australia and Latin America, they're the leader.
So Bryce said earlier that we both worked at Coles and Woolies back in the day, and I remember seeing Shep Pallets, which is their brand.
Yep.
And I'm convinced that they have the best moat in the world. Because if you want to disrupt Shep or Loscam, you don't just have to convince one retailer or logistics company or anyone to sign up to your to your pallet business. You have to get all of them in the supply chain to sign up. The network effect is crazy.
It's an incredible network effect, and Brambles should have been and Shep should have been a lot more successful earlier. But there's a sort of complexity in the business and just sort of tracking where all these pallets were going. And it took them time to do it. But now that they understand that, they're in a position where they can also have more direct conversations with their customers about sort of charging appropriately for that. Again, it wasn't a quick fix, but they've gradually worked their way through it. And if you're the global leader, and roughly in all markets, in the pooled market, CHEP is 80% of the market, and in Australia, Loscam's about 20%. If you look in America, CHEP's about 80%, and Pico is 20%. And if you go to Europe, CHEP's 80%, and LPR is about 20%.
Wow.
So it's the same structure across the world.
So if that's the case, what's the growth thesis? Like, are we looking for continued market penetration? Is it increasing cost? What the price?
It's increasing efficiency, increasing price, more sort of penetration. It's not a sort of fast growing, it's not a sort of WiseTech zero sort of growth situation. But the other thing, which is a big driver of it, and it's exactly the same story as QBE, is that Brambles and QBE have been reducing their volatility of earnings. So you suddenly, rather than getting whipsawed, you have a good year, and then, I don't know, something goes wrong in somewhere in America or something, and then the earnings tank, and then people like us are all up in arms. That's not the case so much now. I mean, Brambles is far more consistent in the way they're able to deliver their earnings and cash flow.
It's surprising. Like QBE, I understand volatility of earnings because they're exposed to natural disasters and things can go wrong. I'm surprised that Brambles had volatile earnings because they've got a steady customer base who are moving like similar volumes of goods through the supply chain. Why were their earnings so volatile?
They just didn't understand their pallet pool. They're like Unilever or Procter & Gamble, all right? Maybe them, but maybe Colgate, maybe Coke, whoever. They were sending pallets to sort of they weren't just sending pallets to sort of suburban Los Angeles and suburban Chicago and suburban New York. They were sending into the back blocks of Montana or, West Virginia and sort of really hard places to get the pallets back, and they get lost. And it's the same thing that was happening in Europe. And so suddenly Brambles was spending a fortune either trying to track these pallets, get them back, or just replacing the pallets. And the pallets weren't lasting long enough. So they weren't charging appropriately for them. Now they've got an understanding of that and where those pallets are. And yes, okay, if you want to send them to, the far reaches of Montana or Idaho, then you're going to get charged for that. And so therefore they're in a position where they can have an appropriate conversation where it recognises the value that CHEP actually delivers to companies like that, because you end up having not to have to replace your pallets. The pallets pool around and come back, Brambles repair them or CHEP repairs them, and then they can be reissued. So you generate an efficiency both for yourself, both for CHEP, but importantly for your customers as well.
Interesting. Was there any concern around the announcements from Liberation Day when it came to Brambles?
Not particularly, because actually most pallets stay within a country. So American pallets, because you put that stuff in containers. So therefore, there weren't many pallets coming in or out of America. So there's an economic sensitivity, but not a huge exposure for Brambles.
So what would be the risks that you're watching? Like, what are the things that would break the thesis?
I mean, the one thing, sort of back on Liberation Day, you have to be careful because they bring in Canadian lumber. So can that be actually replaced with American lumber? Occasionally you get sort of some competitive angst. And occasionally, if you've got a big surge, from the smaller competitors, or if you got just a sort of really severe downturn in the economy, that could sort of slow up the movement of the pallets. And we've seen that. But generally, I think that sort of volatility has been largely removed.
I would have thought by now, surely it's cheaper to make them in some sort of plastic.
That's been tested and tested and tested, but plastic can't be repaired, and then by the time you put fire retardant on, it's actually really expensive. So that's been tested and tested. Yeah. And look, that still may evolve when some new form of polypropylene or PVC or something, but
that's been shown.
Old school lumber.
We don't need more plastic. Come on.
Well, we don't need to chop more trees down.
That is fair.
No, but it is recyclable, and it's actually, they've actually won a lot of sort of awards around that particular point.
It is such a simple product when you think about it. It's wood, a couple of nails, slap some paint on it, and then be a multi-billion-dollar business.
Yeah.
Here's a little boring story for you. Is actually in the early days, the way the business evolved, because CHEP stands for Commonwealth Hire Equipment Pool. They were pallets left behind by the American Army after World War II.
Oh, wow. Okay.
And then they were sold, those pallets, and the Australian government's going, oh, okay, what are we going to do these things? They sold them to Brambles in the 50s. And then Brambles grew the business from there, took it to Europe in the 70s, took it to America in the 90s.
Wow.
That's the story.
Wow, it went full circle from the products that the Americans ditched to now having 80% of the market in America.
Yeah, it's a good story.
Love that. Again, Australians doing the damn thing. Yeah.
Not even New Zealand.
So let's turn to the third company, which is another story of Australians taking the US by storm, which is ResMed. So for people who are unfamiliar, do you want to tell us a bit about what they do?
So ResMed make sleep apnea devices and also the masks that you're sort of required to wear for that. And it's a business that sort of started in Australia, and they are now the global leader, and it treats sleep apnea, which is sort of, for those that have it, it's just an awful condition. They've been able to take that globally. As I said, they've probably got about, across, if you put the devices and the masks together, probably 60% plus market share globally. And so their earnings are still growing at double-digit rate. So it's a really sort of great growth story. Their major competitor, Philips, had a product recall in the US.
Not ideal.
So, it actually put even pressure on ResMed to try and actually sort of meet the demand with that. You also had a lot of volatility recently, and here's a free plug, not just for ourselves, but also for our competitors, is that Australian investors, remember when the GLP-1 drugs seized the market, and you had the American investors absolutely crunching the ResMed share price. And we did a fair bit of work on it. Our analysts did a lot of work on it and looked into it. And we thought, at the margin, it might sort of affect them a bit, these GLP-1 drugs, but we didn't think it would affect them that much. And so when the share price went from 33 to 23 in next to no time, we and our competitors in Australia bought the stock. So the Australian percentage on the register in that period went from 29% to 40%.
Oh, wow.
Wow.
Right?
Nice.
So it's again, not only did, Australian companies doing well, but Australian actually fund managers did well as well at the cost of the Americans. So it was a good story from that point of view. Then, you get the odd bit of volatility because there's sort of new drugs that are brought in that can actually sort of treat sleep apnea. But the efficacy of those drugs is around about 55%, whereas the CPAP machine efficacy is around 90%. So, from time to time it causes volatility, but actually the ResMed product is pretty enduring and in a great place.
Whenever we look at ResMed, the stat that kind of, I guess, keeps us bullish is that I can't remember the exact number, but there's an overwhelming percentage of the population that are undiagnosed.
That's right.
When it comes to sleep. Do you have the numbers?
Google's AI overview has told me 50 to 70% of adults with symptoms of sleep apnea have not been diagnosed. So, it's a big runway.
We're hearing that, and that varies. I think probably in countries like Australia and America, it's probably more diagnosed. So, but as they expand globally as well, then there's actually more opportunities.
So should investors of ResMed not be shouting at the board to say, all you guys need to do is a campaign to get people tested?
Yeah, this is the thing. Do you want better sleep? Are you feeling tired? Go and get a sleep test. Yeah. Why is that not on billboards, on TV?
I think, well, actually, it's a good point, but the problem is because of the FDA issue that Philips had, it actually meant that actually ResMed couldn't meet demand. So they were like,
good problem to have.
Yeah, they were sort of struggling. So no, they were in a good place. And again, this has been a long-term growth story, and the guys have done a great job.
Well, when you next meet the management, maybe just suggest this advertising idea. Yeah.
Maybe they can come on here. Actually, we can start the campaign from ResMed here.
Welcome. So as you mentioned, like Aussie fund managers sort of had a different view to Americans, and that has largely played out so far. It seems like the GLP-1 risk was overblown.
Yep.
But a lot of Aussie fund managers sort of had that view. So now as the share price has recovered, where do you see the company different from sort of market consensus?
I just think the amount of growth left in the business, plus their pricing power, plus the sort of new services as well that they're able to just sort of very aware of where their patients are at as well. So I think they're just it's in a good place to grow organically over a protracted period of time.
It's a nice business as well, where it's like the printer and ink cartridge business, where like you buy the machine and then you've got the consumables that you got to keep buying.
That's so annoying.
It's always used.
It's always the most expensive part.
Yeah.
That's right. I don't think there's anything more expensive than ink,
I know. Yeah. I was hearing recently they'll make a loss on the printer because they make so much on the ink. But
absolutely.
Yeah.
Well, and I mean, it's not quite like that with ResMed. They do make money on machines, but again, their market share is strong. Their competitor, one of their principal competitors, is Chinese, and so that could, there could be sort of tariff issues for those guys, particularly into the US.
Yeah, the product innovation has been interesting as well because my dad has sleep apnea and he's had a CPAP machine, and I just remember early days it was like a big chunky thing, and now they're sleek. They've done the iPhone to sleep apnea machines.
No, they've always got new sort of products coming through, and so their product development has been great as well. So you really can't fault the execution of the strategy over a long period of time.
So we've had our ResMed love in. We've spoken about all the positives. What are some of the negatives? Where are the risks? What could break the thesis for this company?
I mean, if you did get some sort of wonder drug on it, I don't think GLP-1's the issue, but if you got some sort of wonder drug, then you could be at risk. But there's been a lot of attempts at it, and it's never sort of really got close to the performance of what CPAP machines have been able to do.
Well, David, that brings us to the end of our conversation today. Thank you so much for coming in and sharing your time with us. Good luck with the ETF. Just a reminder, it's the First Sentier Geared Australian Share Complex ETF. The ticker is LEVR. David, thank you so much. That was great.
Thanks very much, Bryce and Ren. Thank you.
Thanks, David.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.